rates are negative again. They've been declining over the last year. I mean, that's the fundamental driving force for this new bull market and all bull markets in precious metals. And yeah, I mean, 25 basis point increase. I mean, that's really not going to derail the bull market. I mean, they would need to hike like 50 points and then say they're going to hike again and then hike another 50 points in the next meeting. And we know that there's 0% chance that is going to happen.
Our back up the truck moment is here. Just $10,000 into Keith Neumeyer's last two deals could have been turned into $1.8 million for investors. Now he's going all in with a gold acquisition company, a precious metal mineral bank. We consider this a gold portfolio must. Learn more at futuremoneytrends.com/fortune.
Hello everyone and welcome into crushthestreet.com. I'm Kenneth Amaduri and I requested Jordan Roy-Byrne to come back on the show and give us an update here on gold because he was one of the ones that was saying, hey, look out for the jobs numbers and look out for what the Fed is going to be doing, because during this correction that we are seeing now going towards the end of summer here, going into the fall, we are likely to see gold higher if the numbers don't come in too good, and we are certainly seeing that. Jordan Roy-Byrne is with the dailygold.com, and he's also the author of The Coming Renewal of Gold's Secular Bull Market. Jordan, thanks for joining me.
Hey, thanks for having me, Ken, and thanks for that great introduction.
Well, something you put out earlier this week, if we were watching gold and you said if gold can retake 1350 here on the weekly basis and 1360 on the daily basis, then it would be set up for the next leg to new highs here in 2016. And, we've essentially got there, and I just want to get your thoughts here on where we are with gold.
Well, gold, pulling back a little bit today, but yesterday I think it closed around 1354. I mean, simply put, if you look at the action of gold over the last couple of months, we had a really strong move from early June before Brexit. It went from about 1220 all the way up to 1375 in early July. I mean, Brexit played a big role in the last two-thirds or last half of that move. But since early July, I mean, gold's been in a textbook bullish consolidation where it's had basically a down, up, down. Typically corrections, they have three legs, like I just said, down, up, down, and gold went down, then went back up close to the high, and then went down a little bit below its low in July. But basically, I mean, the low in July, I believe, was about 1310, and gold went a little bit below 1310, but it never closed below 1310. And basically, I mean, it has tried to go below 1310, I think, 3 times since early July, and we had a very strong move the last couple of days. And so that, to me, I mean, looking at that and then also looking at a variety of the charts of the mining stocks, the fact is they're really bullish, and as long as they hold last week's low, I mean, it's a caveat because no one can predict the future. We don't know what's coming, but the probabilities tell me, based on all my analysis and work, if the low from last week holds, the sector, I should say, is really set up to have a strong move into the end of the year. And so, yeah, I'll just say that caveat again, as long as last week's low holds. But looking at gold and looking at all these charts, they look bullish. I mean, we're well above the major long-term moving averages. So there's really no, I don't really see anything coming out of left field or really interrupting this trend in precious metals. We might not zoom to new highs right away in the next week or two. We might go up a little bit more and then consolidate for another week or two. But, I mean, to me, we look in bullish shape here, like we're in position to have a strong move into the end of the year.
I want to talk about that strong move. And, we saw some strong moves during Brexit, and we saw even a strong move this week in gold. And it reminded me of actually how fast markets can move. And, it reminded me of an article I actually read earlier this year, and it was actually talking about the overall stock market for the past 45 years. And basically the article was saying if you bought and held the market since basically 1970, you'd be up 1,910%. However, if you missed out on the top 25 best trading days, you would only be up 371%, which of course suggests much of the gains actually come in short bursts. So do you suspect the gains that are yet to come in gold to play out in short, spectacular bursts, kind of like we've seen?
Well, it's a very great point you make. As far as the question, I don't know how terribly relevant it is, but I think it's relevant to the last couple of days, because if you look at, before that jobs report, we were fairly oversold already, and so even if the jobs report came in strong, I was looking for, maybe we'll go down another 4 or 5% and then have a good rally. But we've seen what happened since that low. Looking at GDX, for example, it made a low of 25, and then yesterday it almost touched 29. That was well over a 10% move in 3 days. GDXJ made a low of 41. 3 days later, I think it went up to 49. So, your point is very well taken, because lows tops are a process, whereas lows happen really fast. And again, that's exactly what we've seen in the last 3 days. You look at gold, it was down there around 1,300 to 1,310. I was thinking, okay, maybe, well, just with the way that it looked, I was thinking gold was going to go to the 1280s and test that level. And, if anyone waited for that, look what happened. It's back up to 1354 yesterday. So, but I think the point is important as far as the long term. I'm really trying to emphasize that to my followers and subscribers, that the most money is going to be made buying and holding. Just trading in and out. You're going to have tax issues, and more likely than not, trading in and out, you're going to miss those best days. And whereas it's just the most amount of money is made by buying and holding over the long run. Now, there's some times where you do want to sell, and periodically you do want to take some gains off the table and maybe put that into other ideas, but that's just what is going to make the most money over the long haul. So people really should focus on buying and holding. In the bull market, what do? You buy weakness and hold, and we got 20% weakness into last week, and that was an opportunity to buy. So that's what I'm telling people: just buy and hold, and when you get weakness, that's the time you want to buy certain things. So I know I deviated a little bit from your question, but I think it's very important in the context of the entire bull market, and really making the most money over a long period of time. You really have to be in the market, and you have to buy and hold. And the final point is, let's remember the low that we had in January. It's a whole nother conversation, but I've done a lot of work on that, showing that the low in gold stocks in January, that was a real historic low. Really, if you look at the gold stocks, their valuation on price to cash flow and those types of things, multi-decade lows. You look at the gold stocks against the stock market, that was at like a 90-year low. Same thing with the gold stocks against the price of gold. That ratio, about a 90-year low, or maybe an all-time low. And given how oversold the gold stocks were just on a 5-10 year basis, my work was telling me that, it wasn't telling me in January because I didn't figure it out for a couple months, but when I was looking at this in the spring, it was really telling me this is a historic low. Like, we're never going to see, the gold stocks be this cheap in our lifetime. And when you have something like that happen, of course, there's a huge move and everybody's worried about, it might go down 20%, it might go down 25%. But the fact is, if you just keep that thought in your mind of how cheap this sector was, that should make it much easier to buy and hold, really, over the long run.
Yeah, and that's something that I've been actually telling people too, and not in that articulate way, but just the simple fact that now that we're moving forward, we can enter this market with more confidence that we are in a bull market and we're not just catching a falling knife. Maybe like we were in January, but in hindsight, that was the best time to buy. But you only know that a little bit after the fact. But now that we got that confirmation, it gives us that confidence that we can enter the sector with maybe a little less downside risk there. Jordan, so would you expect a rate hike to derail gold here going into September, even though the likelihood seems to be just dwindling away?
Yeah, I mean, we were talking before we got on air here, and there's been some negative economic reports. I think the Purchasing Managers Index a week or so ago was below expectations, and then today it looks like there was an ISM report that was below expectations. So that certainly doesn't help the Fed in its quest to try and raise interest rates another time. But I don't really see how they can raise in September. I mean, now they'll probably try and raise in December, but who really knows, to be honest? I mean, there's going to be tons of economic reports coming out until December, and so they can only raise if most of those reports come in pretty strong. But I don't, even if they do hike, I don't really see that derailing this young bull market, because if you look at real interest rates and negative real rates, I mean, one rate hike, I mean, that's 25 basis points. That's really not enough to kind of derail the trend we've seen at real rates. I mean, real rates are negative again. They've been declining over the last year. I mean, that's the fundamental driving force for this new bull market and all bull markets in precious metals. And yeah, I mean, 25 basis point increase. I mean, that's really not going to derail the bull market. I mean, they would need to hike like 50 points and then say they're going to hike again, and then hike another 50 points in the next meeting, and we know that there's 0% chance that is going to happen. So, and I mean, look, the Fed is only going to raise rates when inflation is rising, and what the Fed likes to do historically is they like to let inflation run, and we need to do that now because we need the debt that's out there. We need inflation to help devalue the burden of that debt. So if we do get inflation, the Fed they'll hike, but they'll hike in baby steps. And that's why historically gold has gone up most of the time when they've hiked rates. I mean, especially in the last decade and a couple of times in the 70s, because they hike rates when inflation's going up, and usually they don't hike rates fast enough. And so that just explains why gold has performed really well when the Fed has increased interest rates. And so, yeah, I'm really not worried about the Fed here. I mean, it's a lot of nonsense. I mean, if you see gold looking strong or inflation expectations going up, I mean, maybe the Fed will have some tough talk, and then there'll be a little bit of weakness in gold. And, then if there's a weakness and a bad report comes in, they'll say, oh, well, maybe we won't hike rate. I mean, it's just ridiculous. I mean, they go back and forth. It's just a circle jerk, in my opinion. I mean, sorry for the language there, but I mean, it's just totally ridiculous. And I mean, to be honest, I mean, the Fed, I think, is really going to be irrelevant in the next couple of years. I mean, they might do, but what I see happening is I see them reverting back to QE and then basically doing QE and kind of using QE to finance excessive government spending in the years ahead. So if you just look forward over the next couple of years, that's one area where the policymakers can actually have an impact, is increased government spending. I mean, the infrastructure in our country is falling apart, and that's really, I think, what is probably going to drive the next economic cycle. Is we'll just see massive government spending, kind of like a New Deal, perhaps. But it's just, I mean, that just has to. I don't see how that doesn't happen, and so maybe the Fed would, with their QE nonsense, could finance these huge deficits that the government might have in the next 2, 3, 4 years from having to do all this government spending. But that's really where I see things going. I think that is really what's going to impact the economy, and not this nonsense about waiting the entire year just to do one rate hike. Oh, maybe they won't, maybe they will. I mean, it's just so much nonsense. I mean, we have to follow it, but it's just, I mean, it's been such a waste of so much time for people.
One thing you said was that we need inflation, and I believe I know what you meant by that, but I'd like to just ask you about that. The government, needs inflation to be able to pay their debt and to finance, endless wars and entitlement programs that are horribly reckless. And they need it for increased taxes, all those things. But when it comes to the people are kind of at their max in terms of what they can afford, and the economy is dependent on people spending, and everyone's kind of at their max. We got leveraged debt. Consumer debt is at ridiculous highs. How do you suspect inflating our way out of this is going to impact the common person?
It's a great question. I mean, if we do, I've been thinking we get inflation. Of course, a lot of people have, and we've all been wrong. But I do believe it will happen eventually. If once the government, as I said, if we get deficit spending, that could start to trigger it. And we could see a combination of that plus helicopter money. Basically giving people, tax rebates or one-time tax cuts or something. But that's kind of a way you can do helicopter money. So there could be a combination of that plus that increased government spending, mostly on infrastructure projects. So I think that's what could create inflation. But it's going to hurt the average person a lot. Maybe they'll get paid a little bit more at their job if they're lucky enough to have a job. If they don't have a job, maybe they'll find a job. But the reality is that the cost of living will just keep going up, even though we hear all this talk about, there's no inflation, deflation. Meanwhile, like you mentioned, you just look at the cost of living, it seems like it's going up 7 to 10% every year. And just imagine when we actually start to get inflation in the economy. Then who knows? Maybe they'll say inflation is 4 or 5%, but maybe it'll be 12, 15%. Who knows? And just for the average person, it's not going to be good. Their cost of living will increase fast and faster than their wages, and it'll just be an unfortunate situation for most people. And it is what it is, and all you can do is just try and make as much money as you can and really stay ahead of the game. And that's probably why most of us are in precious metals, because we see the huge opportunity in the years ahead, and that's going to be a way to hopefully make a lot of money and really stay ahead of the game.
Yeah, it's like these elites in power. If we do get the inflation they want, the country will continue down its third world path, and they'll still be able to brag about the numbers that they're getting, because I'm sure it might improve certain numbers and help them go towards the goals that they have set. So, Jordan, one of the things you recently went over in a video where you were actually discussing selling gold, or when to sell. I shouldn't say, completely selling everything. And, I'll just say this is almost blasphemy for some precious metals investors, but I think it's worth the conversation. And of course, to be fair, you were talking a lot about mining stocks and not so much the physical. So just kind of share your thoughts on what you had to say in that video here.
Yeah, well, first I'll say that's a great point on the physical. I'm not talking about that. Physical, you can literally buy and hold and accumulate that. You don't have to worry about selling that for a long time. But yeah, with respect to the stocks, one of the rules I have for selling is if I buy something and it goes down 20%, it's an automatic sell. Now, obviously, that works perfectly in a bear market. In a bull market, it might not work, because maybe you buy something and it corrects 20%, then it goes way back up. But you really, the biggest losses for people are losing money. It's not, I sold this too soon and I could have made X amount of money and I only made, a tenth of that. That doesn't hurt people over the long run. It really hurts people in losses and losing money. And just, you make a bad entry point in a stock and you just let it go down, and you start hoping it's going to turn around. So having a 20% like automatic sell signal. Think about it like this: if you have a diversified portfolio, and let's say on average, each position is 5%. Maybe it's a little bit more, but a 5% position, if that goes down 20%, you sell it. You're limiting your portfolio to only a 1% loss. And the other thing that does is it helps you with your entry points, because I look at things and I think, could this thing go down 20%? like if something has had a really strong move, it has a parabolic move for whatever reason. I'm just talking about in the short term here, not a long-term parabolic move, but maybe you buy a stock and you buy a stock at 3 and it shoots up to like 450, and it's like, okay, this thing is clearly overbought here. It's probably going to correct. It can definitely fall 20%. I mean, those are kind of, when I look at that, those are the kind of things I think, well, if it can go down 20%, I don't want to buy it here. I'll buy something else. I mean, other reasons you should sell, if there's a fundamental change. I mean, if something changes and happens and it's negative, and even if the stock goes down, that's really a great reason for selling. If there's a fundamental change, I mean, you don't want to sit there and hope, oh, well, this bad thing happened, maybe something good will happen now. I mean, you don't want to get in that hoping game. And another reason to sell is if you have a diversified, like a broad diversified portfolio, and if a position does really, really well, it's going to become too large. That it becomes too large as a percentage of the portfolio. Then you want to, I'm not saying sell the whole thing. I mean, just sell, a fraction of that so you can rebalance. I mean, a lot of people, they have these strategies and they talk about, rebalance at the end of every year. So if you have a position that goes up way too much, that's great, but you want to rebalance your portfolio. And in along the same lines, over time, you do want to take profits, but I think you should only take profits in fractions, basically. I mean, maybe you have a stock you really love, and, maybe you every year you're going to sell, a quarter of it, or maybe even a third of it, and then if the stock goes down, you can, of course, buy back into it. But, I mean, that's how professionals sell. I mean, they don't buy something and they just sit there and then they try and sell all of it at one time. I mean, I'm talking about if you buy something, it goes up a lot and it's going to keep going up and you really like it. I mean, over time, it's a good idea to sell bits and pieces of that because that way you're locking in some profit. You're kind of reducing the risk. You're making the position, a little bit smaller, but at the same time, you're still holding it. You still can enjoy those future gains. So those are just, a couple of points that I made in the video. But, I mean, it's really, maybe you have your own plan, but it's a lot different from mine, but at least have some sort of plan. I mean, we don't want to all be just buying and trading and selling these things without any real plan to go along with. Because if you don't have any plan, I mean, you're gonna hurt yourself at some point. So come up with your own plan and try and stick to it and follow it as best you can.
Well, hey, that's great advice there, everyone. Jordan Roy-Byrne. And Jordan, hey, man, you're a class act. If people want to learn more about what you do and, learn more about your plan with precious metals, where would they go and what would they find?
Well, thank you so much, Kenneth, for that. They can go to my website at thedailygold.com. They can opt in there for my free letter, which comes out every Sunday, and I kind of talk about the free work that I've done during the week, and I also give them a little sample of what I did in my premium update that week. My premium service, I send out an update every Saturday evening, and I also do flash updates during the week, and basically we're focusing on precious metals. We do, or focusing on the stocks, I should say, the juniors, and our work is heavily technically based, but when we're looking at the stocks, we write fundamental reports on the companies, so we definitely look at fundamentals with respect to the stocks, and with respect to covering the gold stock indexes and gold and silver. I mean, we look at technicals, and so we're not trying to buy and sell at every point, but we're just trying to use market timing to help people know when's a good time to buy something. Maybe when it looks overbought, that's a time to just hold on to what you have, or maybe sell a tiny bit. So that kind of explains the work that we're doing. But just go to thedailygold.com, and there's a box there near the top where you can opt in, and you get a couple of my reports, including my book, which I did write last year, and I am doing an update for that, which I hope to have out in the next couple of weeks. If you're already on my email list, you will get that update. I mean, when we wrote the book, we were looking at a lot of bearish charts and bear analogs and those types of things. But now that the bull market has returned, I have to do a new chapter update with all these bullish analogs and bullish charts. So I'm very much looking forward to that.
Good deal. Well, everyone, thanks for tuning in today. Jordan, thanks for coming on the show with me.
Thanks so much for having me, Kenneth. My pleasure.